If you bring an IUL to the table, they're not going to give you a loan. There are 2 companies that I've found that will give you a loan, and they give you a 50% or 70% loan to value. Are you kidding me? Like, he's actually ignorant enough to make a statement. And so now what we have is high interest rates that we're going to be plummeting for the next 2 decades. Are you stupid? Banks aren't stupid enough to put their money. Do you think they're buying IUL for themselves? I promise you they're buying whole life, not IUL. Well, you know what's interesting about that? So everybody likes to poo-poo the returns of whole life insurance, right? And you'll hear this from a lot of investors. A lot of people being like, oh, whole life is a horrible investment. First of all, you're right. It's not an investment at all. And if you're looking at whole life as an investment alternative, everybody likes to use buy term and invest the difference as the comparison. I'm like, no, that's not the same conversation. You should look at buy term and save the difference. And if you still think that makes sense, then good for you. Good luck. But it won't. I mean, when you look at it through the lens of like, what do I need this money to do for me? And what problem is this pile of money solving for me? It's not supposed to be your investment. I always call it the BASF of the financial space. If you remember back in the 90s and NFL days and NASCAR, they'd always have a BASF car. BASF would always say, at BASF, we don't make your fishing line, we make it stronger. We don't make the paint you use, we make it brighter. And their whole tagline was, at BASF, we don't make the products you buy, we make the products you buy better. And so whole life is not the investment you make, it just makes the investment you make better. And so that's it. It's the BASF of the financial world. That's what whole life insurance is. And so when we look at this and we go, all right, what do we need our money to do for us? And we start checking boxes of like, all right, I believe we need safe, liquid, guaranteed, accessible capital. And having access to that capital is going to help us be a better investor, right? Like, to me, that's huge, right? And we're not going out and speculating and taking all this risk. If I'm going to keep my money safe, I want to keep it in a place where it's going to be with an institution that I know is going to be stable, right? One mutually held life insurance company has failed since 1840. 560 whatever banks have failed since 2008, right? Okay, like, so I don't know, like,
but no one has problem with flowing their money to a bank.
Well,
that's what we're talking.
Because I know, and so it's all about flow. I think one of the things is hard. I think a confused mind always says no, right? And I think there are certain elements of talks around whole life insurance that are true at some point in time, but are positioned and marketed in a way that don't necessarily make sense to people. And because it seems too good to be true, and in a way it is too good to be true, and eventually it can work, but it doesn't work right away. And I always kind of tell people, you can't solve long-term problems with short-term thinking, right? So we have to be thinking from a long-term perspective, because if we're thinking short-term, well, then guess what? Go put your money in a 5% high-yield savings account right now, and that's going to get you could do infinite banking with a 5% high-yield savings account in a way, and do a collateralized loan and guarantee it with a savings account and all that stuff. But what happens when the savings account rates go back down to 0.1%, 0.5%, something of that nature? It's all these people like to do that. I did a video. It's funny. I did a video 1.5 years, 2 years ago, and it was all about the fact that whole life is a better bond. It's a bond alternative, and it's going to give you like bond-like long-term returns. You're going to have money market-like short-term liquidity, but you're going to get muni bond-like tax treatment, and it's going to be a better overall result for you in life, because that's what really matters. And now people are like watching that video. It's so funny. It's like my most watched video on YouTube right now. It's this short, and it's getting like 500 views a day, and everybody's ripping on me because they're like, oh, bonds are paying 6% now. How do you look? This video aged well and this and that. And I'm like, what an asshat. Like, the whole world changes. It's like, first of all, get the context. 2 years ago, that wasn't the environment. Right now, you have this little bubble of time where you're right. But I'm not doing this for this year. I'm doing this because I'm looking at beyond just getting the return this year. I'm looking at it as a full system to create wealth and backstop that wealth to provide multi-generational wealth. And I think the biggest confusion point that people have is that you do not get wealthy with a whole life policy. The whole life policy can self-complete and make your family wealthy if something tragic happens to you, right? Because if I'm saving money in a savings account, in a high yield savings account, and I die, whatever I got there goes to them and it's going to be taxable. If I die when I save it in a whole life policy, it's called a self-completing plan. That's why I say a properly designed whole life insurance product is the only policy in the world that will make sure, only financial product in the world that will make sure what you want to happen will happen when you want it to happen, whether you're here to see it or not.
Right.
It's because if you die, it self-completes. It's the idea of buy your net worth, build your cash flow.
Right.
Right? If you think about that, you and I, we have a future potential net worth that if we operate as diligent human beings, productive members of society, a life insurance company is going to look at us when we go to apply for insurance and they're going to say, hey, Devin, at some point in time, if you keep doing what you're doing right now, even assuming you don't increase your productive value, right? But in this moment of time, this is how much money we think you're going to be worth in the future if you just keep doing what you're doing.
Right.
Right. And what they do is they call that your human life value.
Right.
And so then they say, hey, Devin, because of the fact that you are doing this and we think your potential future net worth is this, we're going to let you buy that amount of insurance right now. That's how they determine it.
Yep.
Right. So think about it this way. We're all working. And if you think beyond yourself and stop being narcissistic and think about your family, think about the next generations. I'm not talking to you. I'm talking to everybody else. Then you have the ability to realize, like, how powerful is it that I could put my money in a system that I can use it and leverage it to create, ultimately become who I need to be in this world, in this life, to create the life that I want for myself and my family, and have a backstop on the backside of it that if anything happens to me, everything I feel like I'm put on this earth to do will be self-completed in an instant.
I will say when something happens to you.
Sure.
Right? Because
totally.
It's inevitable you're
Right.
going to pass away.
Totally.
And I always tell people to build wealth, you need to get rid of eroding factors.
Mm-hmm.
Things that erode your wealth. And what are those things? Taxes.
Yep.
And paying interest to other people.
Yeah.
Right?
Yep.
So if you start a whole life insurance policy with a mutually owned company that pays dividends,
Yep.
very important.
Yeah.
Not an IUL.
Yeah.
Mutually owned company, whole life. You start that as early as possible in your life.
Totally.
You're giving that money as long as possible to grow until your inevitable death.
Mm-hmm.
When you pass away, it all grew tax-free. When you pass away, it's paid tax-free to your heirs.
Yep.
And if you teach them how to use them, they take that tax-free money and fund more insurance policies on their life that grow tax-free. When their inevitable death happens, it's paid tax-free to their heirs, your grandkids.
Totally.
They should teach their kids, your grandkids, the same thing. So it perpetuates wealth.
100%.
And you can, so that's getting rid of the tax part, right? You can get rid of paying interest to other people, banks and such, by building this this pile of money, this cash value, to borrow from it and pay yourself the interest you would have paid a bank.
Yep.
So now you're actually getting that interest, or you're keeping it, I should say.
You're keeping it.
Instead of giving it to someone else.
Right.
So I want to show you guys. I can't show you, I guess, because you can't see my screen, but
Sure.
I just had my second daughter. She was born on the 2nd.
Awesome.
We've already got a life insurance policy starting on her.
In the works.
Again, guys,
14 days old, basically.
compound interest takes time. So the longer you give it, the bigger it gets. So if we look at this policy, I'm going to be putting in $10,000 a year for the first 21 years of her life.
Okay.
Okay. After that, it drops down to $6,000.
Okay.
I can pay $6,000 on it until she's 95 years old.
Cool.
Okay.
And you can hand this to her.
That's the plan.
Yep.
So $10,000 a year goes in. When she's 21 years old, she has $280,000 in cash value.
Amazing.
So it's made a little bit of money.
Sure.
But here's the thing. I have access to all that cash value in the meantime.
Because you own it and control it.
Right. So I can take the cash value and go make more and start more policies for her.
Sure.
Here's the beautiful thing, and this is why you have to look long term. The first year I put in 10 grand, the cash value is 5,300. A lot of people would look at that and say, well, that's stupid. You just lost $4,700.
Yeah.
Why would you do that?
Sure.
I didn't lose $4,700. I got a death benefit. God forbid my daughter passes away of $525,000.
Right.
So I'm protecting her life with that.
Totally.
using the $5,356 in cash value to go make more.
Mm-hmm.
But you have to look long term. So when she is, let's say 30, $6,000 in premium goes in, the cash value goes up by $27,000.
Well, you know what's interesting about what you just said too? I mean, that's amazing. But I think it's funny that you say, "Oh, I put $10,000 in," and people look at that and they go, "Oh, you only have $5,300, so you lost $4,700 of money." You didn't lose it. You just lost control of that money for a short period of time. Right. If you were to take that money and put it into a 529 savings account, you'd lose 100% control of it.
Yep.
Yet people would be applauding you
Yep.
for planning for the future
Yep.
into an asset that has all this risk and really it doesn't come with any of the benefits, and ultimately is not going to give you the flexibility for the future that you want.
Right.
Right. So it just goes to show how uneducated people are with money. And if people just focused on saying, "Hey, I'm going to get a policy on myself, I'm going to get a policy on my kids, and then when my grandkids are born," you could literally, in this lifetime, you could change the future for generations. And then you start building trust planning into there and all these different things.
That's when it's ninja moves.
Yeah. I mean, now we're talking, you literally can set up like 4, 5, 6 generations out. And I don't care where you are right now. I grew up in a trailer park. You know, everybody has the ability to change the path and the direction of your family.
Yep.
You know, I grew up in Vermont in a little trailer park with a hole in my bedroom floor when it was 20 below zero out, and I had to sleep with 3 blankets on. My parents, full of love, amazing people. I wouldn't be the person I am without them. They know nothing about money.
Right.
You know what I mean? They know, and which, whatever, that's most of America.
Same
right?
with my parents.
Right. And so, you know, you look at kind of where we are now and what we've built, and like, you know, I've had a lot of support emotionally over the years, but not really financially, right? And now, you know, I've got Life 180, we've got all this stuff going on. We just launched a private equity fund. We're buying a hotel in the Dominican Republic. We're moving down to, you know, live on a Caribbean island in the beach, you know, like all these things. And it just goes to show, and I know for generations, my family is never going backwards.
They're just going to get wealthier.
Exactly.
Guaranteed. That's the crazy part. It is a guarantee.
And I mean, how amazing is that? For in one generation, you go from trailer park to
perpetual wealth. Yeah. Because guys, like, I'll touch on this illustration one more time because it speaks right to what you're saying.
Yeah.
Is my daughter, Brooklyn Harper, she will have, let's say, when she's 21, what was it? Just under $280,000 in cash value. She'll never have to borrow from a bank. Like if she wants to go to college, she borrows from her policy. She pays herself back for that instead of paying on a student loan. She wants to buy a car, she uses her policy.
Totally.
I'm going to teach her how to use this, and then I can assign it to her as the owner.
Love it.
So now she funds it. She uses the money. So let's look at when she is likely to die.
Okay.
The average life expectancy for women is right around 80.
Okay.
Right now.
Sure.
Who knows what it'll be when she's 80? It'll probably be 280.
Maybe.
Who knows? But let's say 80 years old. Let's see. She will have cash value of $5.3 million. Okay. Let's say she uses all that money to go make more. Okay. So she goes and buys an apartment building. She buys things that are cash flowing.
Totally.
And she passes away. She doesn't pay any of the cash value back. Her death benefit at that point, it started at $524,000.
Yeah.
It is $6,360,468. Her death benefit would pay off all the loans she took, $5.3 million. So her family, my grandkids, would get $1 million tax free.
Yep.
They'd also get all the stuff she bought
and all the assets debt free.
Right. So now they control all the assets 100%. She bought with no debt. And they take the $1 million that's tax-free to buy more policies on themselves so that, again, the wealth just perpetuates.
And if those assets are real estate, in today's tax code, it's a step up in cost basis.
Yes.
And so the tax advantage is huge.
Yes.
It's amazing.
It is the best foundation. I can't speak today. Foundational.
Were you sucking on ice cubes before I got here? Like, what's going on? Is your mouth numb?
No, I had surgery on my mouth.
Oh.
I got bone grafting. So like it just feels different in my mouth. So that's probably what it is.
Learning to talk again. It's okay.
It's the best foundational asset you can have.
Yeah.
Because literally all it does is just makes all of your dollars more efficient.
Yep.
That's
Totally.
it.
But it takes time.
It takes
Right?
time.
So my question to anybody is, would you be willing to go through a 7-year capitalization phase where maybe it's a little less efficient from a bank if you knew for 5 generations it would change everything for your family?
Right.
If the answer is no, go watch a different channel.
Look yourself in the mirror and ask if you have a heart.
Yeah, I mean,
Right.
totally. That's the way I look at it.
It's an incredible asset, and it is an asset. It actually is an asset.
Totally. Of course.
We had a property we just bought last year, Airbnb, and they wanted to see 6 months of reserves
Okay.
for the payment.
Yep.
We don't keep a lot of money in the banks, so we deploy the money or it's in policies.
Sure.
Right? So in each bank account I have, I think I keep generally around $5,000 tops. So we didn't have the 6 months of reserves in the bank account. We showed a cash value statement.
It was good enough for them.
Good enough for them. It is literally an asset that you can use to buy real estate. I mean,
Why wouldn't it be a good enough asset for the bank when 20 to 25% of most banks' liquid capital reserves are sitting in whole life or properly valued life insurance?
let's
right?
talk about that.
Yeah.
So
I mean,
how much? I know the answer to this. A lot of people probably don't.
right.
So banks own billions upon billions
Yep.
upon billions of
Yep.
dollars worth of whole life insurance.
Yeah.
How much do they own of IULs?
So the answer. So this is hard. The answer is nobody really knows. I'm going to say not much. And a lot of IUL agents right now are saying that banks own all this IUL. No, banks own cash value life insurance. That's the only thing. It doesn't go on the books as whole life insurance or IUL. It just goes on as cash value life insurance. But if you look at how BOLI has been owned and how long it's been owned, and you look at let's actually go there. Let's go, why do life insurance companies even use whole life insurance in the first place? This goes back to the beginning of our conversation about...
Why do banks use it?
Yeah.
Yeah.
So this goes back to our conversation from the beginning, talking about the transition of the dollars, right? So if you go back to the fact that we've had 3 different versions of the U.S. dollar, we could actually probably say 4 if you count for going off the gold standard in 1971, but it's been technically the same banking system and dollar still, right, with the Federal Reserve. So 1840, life insurance companies were launched. 1860, the Civil War happened. All the money printing and all the problems with Civil War. We had that currency died.
Wasn't it the Confederate
Yeah,
dollar?
I can't remember the names of it right now, but I've done a video on this exact, like going through step by step. But that currency died. 1870s, that currency that we had, the currency that replaced the one that failed because of the Civil War in the late 1870s, that one died. And then we had a different currency until 1913, when everybody knows the Federal Reserve Act and the institution of the Federal Reserve, greatest theft of history of mankind.
Good old tax code.
Yep. And so that got launched, and we've been living in this dollar system ever since. But that was 70 years that they had 3 different versions, and in the infancy of the life insurance space, right? And so, but think about, why do banks utilize in our current banking system from 1913 to today? Why do banks use whole life insurance? Is because J.P. Morgan and all his banking cronies, if you ever read the book Creatures from Jekyll Island,
Such a good book.
all of those people who, started this banking institution as a way to get Main Street America to put their money in there so they can leverage our money to create wealth for themselves. All of the banking people, where did they have their money before? Because the pitch for the Federal Reserve and the banking system was to create stability, right? So they all knew it was a problem, and they didn't trust banks before. So where did they keep their money? They kept it with whole life insurance companies before 1913.
Right.
So they created the Federal Reserve Act, and they created the banking institution system as we know it today. But when it started, they had all their money in whole life companies. So they said, so it just made sense to utilize whole life insurance as a tier 1 foundational asset, right? Because that's what they were already doing.
Right.
And they knew that was going to provide the stability. And so they started utilizing it as a tier 1 asset, and they basically created this marketing scheme to get everybody to give our money to the bank so they could then turn around and put it in real estate and whole life insurance. It's one of the reasons I love real estate and whole life insurance so much, because that's what banks do.
Yep.
You know?
And the most profitable business is banking.
Totally.
So why in the world would we be infinite bankers? Why would we do that? It doesn't make sense.
Yeah, I know.
That doesn't make sense.
People don't understand money. That's why I always tell people math and money are different. You know, the money math is way different than math, you know, and people just don't understand it because it's so outside of the way we're taught in school.
So I'm thinking, like, as you're saying that, I'm thinking like listeners and viewers, they're probably like,
what?
How in the world would a bank get a life insurance policy? It's very simple, guys. The bank can insure a key employee. So go to any bank and look around at how many vice presidents there are. Everybody's a vice president. So what happens when you become a vice president at a bank? The bank promotes you, gives you a little bump in your pay, and they say you're going to get a fully paid up life insurance policy. So you don't have to pay a penny into it. It's fully paid up.
Yeah.
When you pass away, if you're still working here, your family will get $50,000, whatever the number is.
Sure.
How much is that policy actually for, though? $1 million, $2 million, $3 million?
Sure.
So they'll give your family 50. They'll get whatever else it is tax-free. So they're insuring an employee. That's how they can actually get these policies.
Right.
They can't get it on the building.
Right.
It's on the employee.
Totally.
Right?
Yeah. You have to insure somebody's life.
Right.
Yep. Yeah. I mean, and then the cash value in that asset is an asset on the balance sheet of the bank.
Right.
And all you have to do. So it's interesting. Dave Ramsey launched a video maybe 2-3 months ago, and it was like heated debate with Infinite Banker, right? And first of all, it wasn't really an infinite banker. It was a guy who was thinking about getting infinite banking, and he didn't really understand it all.
Oh.
And so Dave loves to do these videos where he like beats up on people that don't really understand what they're talking about, you know, and so he looks really smart, and then he makes his video public to the world and tries to back his point up. And so in the video, the guy, you know, Dave Ramsey's ridiculing him, and the guy's like, well, you know, why wouldn't I do this? This is what the banks are doing. Dave Ramsey literally goes, are you stupid? Banks aren't stupid enough to put their money into a horrible product like whole life insurance. That's what Dave Ramsey says. And I'm like, are you kidding me? Like, he's actually ignorant enough to make a statement? Is he that arrogant? Is he that narcissistic? Is he that out of touch with reality? Does he either not know, or is he buying his own BS, or like what the deal? So I did a review on this, and I went through and I said, all right, I'm going to go online, and there's a website. I can't remember the name of it. I got it bookmarked. But it lists out assets in life insurance by every bank in the country. There are 3,000 banks in this country with over $10 million of whole life insurance, or cash value life insurance assets. We don't know, going back to before, if it's whole life or IUL. I'll fully, openly acknowledge that. What I can tell you is that IUL didn't even exist until 1997, and that life insurance, or banks have been doing this since 1913.
Right.
So, and here's what I say when people go, well, why wouldn't they switch? Why wouldn't they switch? I'm going to go to the insurance-backed line of credit, or the cash value line of credit. You can go to a bank and ask for a line of credit, leveraging and collateralizing the cash value in your whole life policy, and they'll give you 95 to 100% value of the cash value and a line of credit on it. If you bring an IUL to the table, they're not going to give you a loan. There are two companies that I've found that will give you a loan, and they give you a 50% or 70% loan to value. So if a bank is smart enough to know that your IUL is way more risky, and they won't even give you a loan against it the same way, do you think they're buying IUL for themselves? I promise you they're buying whole life, not IUL. Just 100%. Look at the way they treat IUL, and look at the way history has played out.
Just logically.
Listen, I live and breathe this stuff, and so do you, and people watching probably don't, but like when you really understand what to look for, the facts aren't there. I mean, they're not. Like there's no bank that says this is our whole life insurance assets. They say, here are our cash value assets of life insurance. And so that allows these snaky IUL agents to slip in and be like, IUL's a cash value, look what they're doing, right? But if you really break down and you understand what to look for and the critical questions to ask, it's easy to use a little like fourth grade deductive reasoning and come to the conclusion that they definitely are not doing IUL.
One big thing is that it came around in 1997.
Yeah.
Whole life. The first life insurance policies, they were term, I believe, in like the 1700s.
Yeah.
Right. So,
yeah. There's all sorts of different insurance companies. History of insurance goes all the way back to England, and like there's all sorts of stuff. Yeah.
But if you look at 1997 is when IULs came out, and when the banking system came about, which was with the tax code, was 1913. Right.
Yep.
And you touched on it. Why would all these super wealthy people put their money into life insurance? Why would the banks do it? Because all the wealthy people were doing it before.
Sure.
Who started the modern system? The Rockefellers, J.P. Morgan Chase, and the president at the time.
Carnegie was, or it was
Lendell?
Yeah, I can't. He was a.
I forget who the president was, but they basically all came together, and there was a problem in America. America was a place where you had entrepreneurs. They came here to be business owners. Those people, mainly Rockefellers, the Vanderbilts, and J.P. Morgan Chase, they said, you know what? We need more employees. We need more people to be employees to build our
system.
Yeah,
our empires.
Yeah, everyone can't just be their own business owners.
Right.
So what do? They create the schooling system where you indoctrinate people into being employees and pump out more employees so they can.
Totally.
Again, that's the system. So then what do? J.P. Morgan Chase, banking. Money goes into policies from the banking system.
Totally.
It's all perpetuated, and that's how it is formed. And people are so blind to what's actually happening.
So true.
There's a quote that says, the biggest problem in America is not what people don't know. It's what they think they know that just ain't so.
Yep. It's so true. The problem is people think they know something, and it's just not the case. Like, so for instance, if you were to ask anybody, what's the average rate of return I should expect in my investments in the S&P 500? What do you think they'd say? Like an average American.
8 to 10%.
8 to 10%. Okay. My question to you is why?
Because that's what I've been told.
Okay. And so I literally just did this video because I a couple days ago, because I realized, like, I'm a critical thinker, and the first thing I always ask is why, right? And it's just, I think we need to start asking why more often. And so I went down this path being like, all right, why do people believe that? Well, we go back in history. I was born in 1980. When were you born?
85.
85. So I was born in 1980. So it lines up perfectly with these stats. So in 1980, what was happening? Interest rates were at all-time highs. Inflation was at 13.5%. Interest rates were over 19%. Mortgage rates were over 20%. We look at everything that was going on. So rates were at an all-time high, which means that was sucking money out of the economy. Things were tough. And then it was also the creation of the 401k. 1981, the 401k became popularized. And it became where the government passed a law, because actually 401ks were created in 1978, but in 1981, a law got passed where people could do tax-deductible contributions to their 401k in 1981, okay? And so now what we have is high interest rates that were going to be plummeting for the next 2 decades, right? And we had, all of a sudden, every person on Main Street that had never thought about investing in mutual funds or the stock market became an investor. And so if you know anything about supply and demand, you now have millions of people that are flooding money into a low supply environment. That's what created the booming 80s, is reducing interest rates and this massive influx of new investment capital.
Right.
That's it. It's not more complicated than that, right? And so from 1980 to 1999, do you know what the average return, like, of the S&P and the Dow and like all the indexes were?
The average or the actual?
The actual.
Actual
Let's
return.
Let's talk actual.
I would say 4.
The actual was 15.4.
Really?
From 1980 to 1999.
Wait, okay. I'm thinking of the last 20 years. I apologize.
No. So I'm saying 1980 to 1999.
Got it.
Okay.
Actual return was 15.
15.4.
Wow.
So, but the world we live in today.
Wish I could have invested as a little toddler.
Right. So think about this. Think about this, though. Why do people believe that go to school, get a job, invest in your 401k, all that stuff is the way to do things, because that's what worked for 20 years when it first was created. But here's the crazy part. This is the crazy part. Look from 1929 to 1979, a 50-year window preceding that 20-year period. Mm-hmm. Do you know what the actual return was?
Negative?
It was 3.4%.
Okay.
Okay. So so that's 1929 to 1979. That's 50 years. From 2000 to today, do you know what it is?
I think it's about 4.
It's about 4.8.
Right.
Okay. And that's just because it's going better this year, right? And so when you look at, we had about 4% before 1980 and about 4+% after 1999. We had that 20-year window where it was 15%, and everybody's saying you should expect 8 to 10% because that was the time when all of the marketing around all these retirement plans came out, and the whole world around us was never the way it was, that's not how it was before, and it's not been the way it stayed, but nobody has taken hit the pause button to say, what's going on here?